Oh, sorry for the delay. Today we're going to be talking a bit about ratio analysis. Now, before I start, I just want to remind everybody, technically I'm trying to record this lecture, so we don't have lecture recording capabilities in this classroom. I have a microphone here, and if you've seen on iLearn, there is lecture recordings from the past week. The sound quality is not amazing. It's basically just there in case you miss it, so it's better than nothing. So this microphone is not meant to pick up voice for, I guess, from longer distances, which is why the quality is not great. I'm going to try and see if we can get a better mic for next week. But again, the lecture recordings will be available under subject recordings on iLearn. It will be the Tuesday session. I can't guarantee that the quality is awesome, but again, it's just there as a backup. Today what we're going to be doing is going into ratio analysis, which is really a topic that kind of can be covered under the idea that we're trying to tell a story about a business. So ratio analysis is effectively just a progression of what we did last week. So if we start out with like week one, we'll learn some stuff about a business. In week two, we figured out what some of their accounting policies were. And the point of week two in particular, and specifically if you would have found something wrong with the accounting, is that you might have made some adjustments. So say, for example, you might have found that the goodwill was overstated. So you might have made an adjustment. So you might have written it down slightly. And the idea is that those inputs can then be used this week to tell a story. So ratio analysis is kind of the highlight of today, but it's really under the overarching idea of financial analysis in general. And financial analysis is really to try to understand how a company has performed in the past. And financial analysis, it's not necessarily just about numbers, because the numbers are really indicators. It's never the answers. If somebody asks you, what is the return on assets for this company? The answer is never 15%, because really what they want to know is, yes, what is the number, but why is that the number? So why is it 15%, not 16? How is it in comparison to prior years? How is it in comparison to competitors? But not only that, but you essentially need to be able to explain why something is occurring. So not only that it's gone up or down, that it's worse or better than competitors, but also why is it happening? So in telling a story and trying to understand the past, what we're trying to do is understand the past in order to predict the future. So this kind of directly links into forecasting, which we cover in week 5. So forecasting, generally speaking, it's kind of a future prediction, and you can't predict the future really. So all you can do is make a best guess based on some form of kind of knowledge. And that knowledge comes directly from ratio analysis and financial analysis in general. So when we try to tell a story, again, this week we're focusing mostly on ratio analysis, but you can use many other different types of approaches. You might just use graphics. So I see a lot of students when they present the final report, it's just words, and words are just boring. Sometimes you can just use a graph to tell something much more quickly. So if you want to break down the operating segments, it's much easier for me to read this than if you were to give me a paragraph of text, tell me exactly the same information, because this provides me with the visual input. So again, when in doubt, use a graph. I'm not saying that you shouldn't supplement with some analysis. So you might say in the analysis section, you might comment on why this breakdown actually occurs. So why is it that, for example, Greater Asia or Africa is 22% of the operating profit of this company, but it's not necessarily that useful for me in the paragraph form to read essentially these numbers again. So when you're using graphs, don't necessarily just replicate, but supplement it in the sense that here you get provided with the basic information. The analysis which you write up, that's where you get the greater understanding of why things are the way that they are. So again, many different graphs out there. You can use bar charts, you can use stack charts, and so on. The idea is essentially that you're trying to tell a story. So here, for example, you might look, instead of looking at operating profits for one particular year in the previous slide, you might look at how has it developed over time. So the idea is essentially, depending on what story you want to tell, you're going to use a slightly different graph. So here's, for example, where you try to break it down by country and still showing the progression by country from year to year. So again, this is not rocket science. It's really just figuring out which graph is the best for this particular purpose. And generally speaking, just Googling things in terms of which graph is the best for showing a change over time, which graph is best to break down segments. So if you Google, you can usually find the answer which graph is the most suitable. Probably my pet peeve when it comes to graphs, if you do graphs, is that you should always start at 0. So sometimes people like to, in order to show an effect, they like to start at, let's say, 600, because then the effects become much larger, which is somewhat deceiving because you're essentially making it seem like there's a much larger change than there actually is. So again, when using a graph, start at 0 or whatever the natural amount is. Again, different types of graphs are for different types of purposes. We are also going to be using regression, especially when we come to the next week when we do some risk analysis and also forecasting. So say, for example, you wanted to tell a story about a company's sales growth in the past. Well, you can look at its sales growth in the past in isolation to say that it's increased or decreased over time. It was 5%, then it was 6%, and so on. Or you can try to explain it by using some form of analysis. So in this case, you might run a regression to look at how sales growth is related to GDP change. So essentially, you plot out all the quarterly observations that you have in terms of sales growth and GDP change, and you're essentially estimating the line of best fit. What it essentially provides you with is a way to forecast future sales based on estimations of GDP change in the future. Again, this is something that we're covering probably in later weeks. So generally speaking, again, graphs and so on, that's really, really basic. If we're going to be looking at, I guess, how we're going to start our financial analysis. So our financial analysis or even our ratio analysis, you basically need to keep in mind what the purpose is. The purpose is to tell a story. I'm not saying that you need to make up a story, but you need to be able to explain why things have occurred. So nobody is interested in what the changes are in the ratios from year to year unless you can explain why that has happened. And the way that you usually do that is several different approaches. So the first approach that you could do is use something called common size analysis. So common size analysis just expresses any form of financial data in relation to something else. Generally speaking, it's very, very popular to use on the balance sheet items. Specifically, if we were to look at assets and break down all assets as a percent of total assets. The idea is that you from year to year can see any major changes in their asset composition. Similarly, you can do this with income statement as a percentage of revenue or cash flow statements as a percentage of sales, assets, or total in and out. Again, the idea is that it highlights the composition and any changes. And you can do this in terms of, I guess, comparing both year to year and company to company. And similarly, if you want to focus on one particular company specifically, what you can do is horizontal common size analysis, which is essentially comparing year to year in terms of its growth or growth factor. And again, the next few slides just gives a few examples in terms of how it looks. So again, this example just shows a common size analysis of your total assets for period 1 and period 2. So again, if we look at total assets as 100%, we can look at what is the percentage term of cash that we hold as a percentage term of our total assets. What is the percent of receivables, inventory, and so on. The point of this whole exercise is to understand the asset composition. So for example, from year 1 to 2, we can see a huge change in some of these items, specifically when it comes to receivables. And again, this is something that could be used in terms of the prior week when we looked at red flags. So again, this would indicate that there is a red flag in the sense that there is a much stronger influence of receivables. In the sense that receivables are now 57% of our total assets. So whenever we see receivables increasing in size, we need to basically ask ourselves why. And again, as I highlighted, this is never the answer. This is just a starting point. This provides you with the idea that I might need to look into why has receivables grown, why has inventory decreased, why has cash decreased. And then you go through the notes, you go through PR releases, you go through management communication to understand why this has occurred. So the idea is to always answer why. And again, you can use this to compare different companies because again, technically speaking, if we're looking at the previous example, we don't know which year is the better year technically. Because it could be that in this particular industry, the norm is to have receivables at a certain rate. So it could be that period 1 was the weird one where they had a very low amount of receivables. Can anybody think of why might low receivables be a bad thing? Well, that's more why is high receivables bad? But what's the opposite? So is there any reason why high receivable, or I should say low receivables, is a bad thing?
Not enough sales.
Not enough sales. So technically speaking, yes, receivables are risky, you might not collect, but to me, a low receivables on the flip side would indicate they might have too strict credit policies. If they have too strict credit policies, they're actually losing out on sales. So when we're looking at any of these ratios, generally speaking, there is a obvious answer in the sense that high receivables bad, but there's also a not so obvious answer for why low receivables might be bad as well. So again, you basically need to look at it in relation to something else. And that something else could be by comparing it to a company that's similar. And the idea is that you're trying to find a benchmark. Generally speaking, you probably won't compare it to one single company. You'll compare it to a number of different companies that are similar, and you average them out. And the idea is that your benchmark then becomes some form of information for what is normal amongst your peers. So again, if you're looking at company one, we can see that their receivables is 33% of their total assets, whereas for company two, it's 55%. So again, we're looking at how do they differ between each other. And again, there's no, I guess, right or wrong here. You're just trying to understand why is it the case? Is it because company one has a slightly different credit policy strategy? Is it because they're better at collecting credit sales? So there's a number of different answers. And again, you want to understand why. So effectively speaking, when somebody asks you to do ratio analysis or any form of financial analysis, they want you to get to the point where you can't ask why anymore. So let's say, for example, you say that return on equity has gone up. So return on equity is basically your net income divided by your average total equity. So the next question is then, well, what has caused the increase? Is it the net income or is it the equity? If it's the net income, again, I'm going to ask, why has net income gone up? You're going to say, well, perhaps revenues went up. Again, I'm going to ask, why did revenues go up? And you might look into the segment sales and say, well, sales in this particular region went up. And I'm going to ask you, why did they go up? Is it because of strategy? Is it an accident? Could it be just foreign exchange fluctuations in the sense that the sales might be boosted just because foreign exchange rates have been great? So generally speaking, you want to get to the point where somebody can't ask you why anymore. And it's really difficult to get to this point without actually being able to consult management. But again, the notes usually provide you with ample information. There's so much communication from management to the general public that can usually get to a pretty good point just from publicly available information. So again, here's an example of just, I guess, year-to-year sales. So you might look at a horizontal analysis and see that receivables has gone up by 38%, inventory has gone up by 58%, revenue's gone up by 19%. And again, this is a really old example of Sunbeam, and essentially what happened back then is that Sunbeam created some fictitious sales, boosted their earnings a bit by manipulating their accounts, and usually you see something like this, and similar to what we did last week when it comes to the red flag analysis. Whenever you see your receivables growing at a much higher rate than the revenue, ask questions. Why is this happening? Whenever you see inventory increase, why is this happening? So again, you want to understand why something is occurring. So generally speaking, again, the whole point of ratios and what we're focusing on today is really to express something in relation to something else. So you could compare to companies' net income or net profits or whatever you want to call it, but there's going to be size issues in the sense that if you wanted to compare apples to apples, you really can't because most companies are different. So the easiest way to standardize things is to kind of express one number in relation to another. And probably what's really confusing, and you will be confused when you start to read the readings. I'm not sure, has anybody read the readings yet? Or it's pretty long. I'll give you that. It's pretty long, it's pretty technical, but it's very comprehensive. So once you start reading the readings, you might notice, for example, that they use, in order to calculate return on equity, they use net income divided by average total assets. You then might go to Investopedia, which I know a lot of you use, and you might find that Investopedia prefers earnings before interest and tax divided by total equity. The point here is really there's no standardized way to calculate any form of ratio. So effectively speaking, depending on which service or which provider you get the information from, they might calculate it slightly differently and it might give you different numbers. So if you were, for example, to fetch numbers from Bloomberg for return on equity and all these various ratios, how they calculate it might be very different from like Yahoo Finance or Google Finance. So the idea is that if you're using numbers that have been pre-calculated for you, you need to understand how they've actually kind of gotten there. So generally speaking, when we're looking at ratios, you really need to understand how was it calculated, and also don't get fooled just by looking at ratios. So I see a lot of students basically calculating a bunch of ratios and looking for trends or anything. So they see a flat ratio and they think, well, there's nothing here. Technically speaking, that's not true because it could be that it's a proportional change in the underlying numbers. So if you're looking at return on equity and hasn't changed, perhaps returns and equity increase by the same proportion. That's still interesting to explain from an analysis perspective, but it might not be the obvious if you're just looking at a flat ratio. So the idea what you're trying to do is essentially just to understand what is happening to tell a story. And ratios is just one tool for you to tell a story. One important thing is also when we're looking at just computation on ratios, you will have an issue with some companies, and I think Time Warner. For example, Time Warner has a very particular situation where I think about 15 years ago they had to write off $100 billion, which led to a negative equity within their firm for a long time. Which means, for example, if you take a negative return, so a negative profit divided by a negative equity in your company, you actually get a positive return on equity. So when you have two negatives, they cancel each other out. So you can't just look at the numbers that you get at the end. You need to understand what are the drivers. So again, you need to watch out for when you have double negatives, both on the numerator and the denominator. And again, ratios are interrelated, and we're going to be looking at DuPont analysis for this. And again, I know you guys would have done DuPont analysis in some other class here and there. Most of you kind of remember kind of what it is. Some of you might have completely forgotten it. That's completely fine. The whole point of DuPont analysis is to be able to decompose the profitability of a company into different parts to understand how are they doing when it comes to their profitability, their asset efficiency, their leverage, and so forth. So again, as I mentioned, ratio analysis. So a ratio will never be the answer. So even in an exam situation, if they ask you how profitable will company X, don't give a number. Even if it says what is the return on assets for company X, don't give just one number, because generally speaking, you can usually expand almost always. So generally speaking, a ratio will always be a first step in a process. So it'll always just be the first step in trying to figure out why is that number that number. And this is a really bad answer if you're looking at it from a project perspective. So say, for example, you have a section on profitability and you say that they had 15.26% on return on assets. Again, that's a really bad section because it doesn't tell me how it's done over the past few years. It doesn't tell me how it's done in relation to the industry. And more importantly, it hasn't explained why those differences are actually there. So is there a strategy reason? Is it a macroeconomic effect? Is it an industry effect? So generally speaking, whenever you see a difference in ratios, there will be either macro, industry, company strategy. Those are the three kind of explanatory concepts that you can use to try to explain why things are different. So again, you could try to improve it slightly in a sense. Company X profitability has improved. Its net profit margin was 15.3%, up from 14.9% last year. Again, progression in terms of adding to the answer, but again, technically speaking, even this could be improved by, for example, relating it to comparing it to other companies. So we know that it's has increased from 14.9 to 15.3, but we still don't know whether this is a good ratio in general, because it could be that even 15.3 is a horrible ratio for this particular industry. So again, usually you might add things around I guess a comparison. So you could use company Y in the sense that company X was more profitable than company Y, as evidenced by the differences in the profit margins. And again, technically speaking, this is better answer, But if you have the information, if you have access to the financial reports, if you have access to the notes, you need to explain why this has happened. And again, think about it from a process point of view. Is there a macroeconomic difference? Perhaps they're in different countries. Is there an industry difference? Well, generally speaking, if you're comparing firms, they should be in the same industry, hopefully. Or is there a strategy difference? And generally speaking, if there is a strategy difference, that is the real one that you want to be able to explain. Because if you think about it from a company's point of view into the future, strategy is something they can change. Industry and macroeconomic effects, those are kind of forced upon them. Strategy is something they can easily change themselves. Sometimes not that easy, but again, it's something that they can try to improve. So again, when we're looking at ratio analysis, computation is not analysis. Calculating something is really just the first step. So it's really going beyond just collecting data and calculating things in Excel. So again, for the homework this week, all you're doing in Excel is computation. The idea is for the Thursday session is that you then start to use the outputs of those computations to try to explain why changes have occurred or even why things have been the same for the past few years. So again, what we want to understand is past performance. And again, the reason why we want to understand past performance is to predict the future. The only reason why we care about past performance is to predict the future, which also means that you need to consider some things. So if we're only interested in doing a ratio analysis or any form of analysis of the past to predict the future, you need to make sure that the company has not changed dramatically. So for example, if you're dealing with a stable company, you might actually go back 5 years in time to look at the trend over the past 5 years. If you're looking at a company that's growing quite significantly from year to year, you're going to use a much shorter time period. And the idea is that you only go back as far as basically it is relevant. So the further you go back, the more information you get, but the further you go back, the less relevant that information generally becomes. Also, some of the other issues that tend to kind of pop up when it comes to ratio analysis is things like acquisitions. So if your project company has acquired another company and it's significant acquisition, it will completely mess up any form of ratio analysis. And the idea is, again, when you acquire somebody and you then bring them into your balance sheet, you essentially have a huge change from the year that you acquired them to the prior year, which means that you see a huge jump in ratios, but you can't really, I guess in a qualitative way, explain whether that is a good or a bad change, because you don't know the counterfactual, which is basically what would have happened if there was no acquisition. So again, we essentially just want to understand why things have happened, and being able to look at company events is being able to somehow explain why things have kind of happened. So again, what we're looking at specifically is what aspects of the company performance are critical to successfully competing in the industry. Generally speaking, this is something that you would have probably done maybe in week 1 if you had time. So again, that was around things like Pastel analysis or SWOT analysis, all these various tools you might have learned in your management classes. And the idea is by using those tools, you might be able to see that, for example, this particular industry has huge barriers to entry, which means that we need to be large enough to be able to compete in this industry, because the smaller you are, the generally the harder it is to kind of enter. You could look at how the company performed relative to its own history or competitors. And again, overarching all of this is the question of why. So what caused company performance? And this again, when I grade assignments, when I grade exams, when I grade your projects, I want the answer to why things happened. So it's really easy to calculate ratios and basically just write up that the ratio has increased from 14.9% to 15.7%. Then you go on Investopedia and say, well, this ratio indicates a strong liquidity. So you could use all these things, but it's not going to tell me why something happened. So why something happened is the most important part. So for that, you really need to understand what is the economy as a whole. Is there a recession? Is there a boom right now? So could it be because the economy is doing so well right now and that's the only reason why the company is doing so well? So if that's the reason, well, I'm not necessarily going to be too too concerned about management's ability to implement strategy if that is not the reason why they're performing so well. And similarly, perhaps it's just an industry effect. Perhaps the industry has had an extreme amount of regulation introduced this particular year, which has caused a decrease in financial performance. And again, if it's an industry effect, I'm not going to be as harsh on the company because, again, it's kind of out of their hands. Now, they can try to go around it, but again, it's something that takes time. The one that is most important is really about strategy. So is there something about the company's strategy that can explain this particular ratio? So say, for example, you're going to compare the performance of different companies. So you might compare the performance of, let's say, Toyota and, let's say, BMW. You will probably find differences in their financial ratios, but it might not necessarily be because one is performing bad or one is performing poorly and the other one is performing well. It could just be a reflection of their company's strategy. So for example, Toyota will generally have a high volume, low profit margin approach. BMW will have a much higher profit margin approach and kind of lower volume. So depending on the strategy of the company, you will usually see it reflected in the performance. So essentially, you always need to kind of keep that in mind when you're trying to answer why something has actually happened. Overarching all the different ratios we're going to cover soon is really not every ratio is relevant for every company. So certain ratios that we're covering this week are not relevant for certain situations. Also, whenever you don't see a ratio in the next few slides, it does not mean that it's not relevant. So things that I don't cover does not mean that you basically can ignore them. So if you find, for example, when you do your research, that when people talk about the industry that my company is in, they use a weird ratio, like say, for example, you're analyzing airlines and they look at revenue per mile flown. Just because I'm not covering it does not mean it's irrelevant. If people are talking about it, include it, because most likely it's something that is incredibly important for this particular company, because it's in a specific industry. So the idea is that some ratios might not be important in certain situations, others might be in other situations. Generally speaking, there's basically an endless amount of ratios out there. You can never learn all of them. So the idea is that you're trying to figure out which industry am I in, what kind of strategy do I have, and then try to figure out what kind of ratios might be important for me. So again, when we're looking at ratio analysis, we tend to categorize ratios into things like solvency ratios, profitability ratios. But again, overall kind of point is to try to tell a story and explain why things have occurred. And again, we've covered this in different classes, and I've mentioned in this class even, differences in accounting standards will limit comparability. So if you're comparing companies that use slightly different accounting standards, even US GAAP and IFRS, there's going to be differences in comparability because some numbers are calculated slightly differently. Also, when we're looking at accounting standards, just because both companies are using IFRS does not mean they're perfectly comparable, because in one country they might have a conservative culture, which effectively just means that they're going to prefer historical cost over fair value. So if I were to compare a German company that's really old with a UK company, usually the UK company will have a much larger propensity to use fair valuation versus the German company. That's just a cultural effect. And those are some of the things that we kind of need to consider if we have international competitors. So again, there's different ratios for different purposes. Generally speaking, you could categorize them according to this categorization, but again, it's just one way to categorize things. So you could look at activity ratios, which is really just about how efficient a company is at using their assets. You could look at liquidity ratios, which is really about the company's ability to meet short-term obligations. The solvency ratios, which is about more long-term obligations. And then finally, profitability ratios, which is really just about the general profitability of the firm. And generally, again, most of these things are interrelated. So just because you're looking at one category does not mean that you can kind of ignore all the information that you learn from the other category, because they will usually be interrelated. So the first one that we're going to be covering is profitability ratios. Now again, I know you would have covered some profitability ratios in the past, but it's been a few semesters. You probably would have forgotten 90% of it, and that's fine. So if we're looking at profitability ratios, the most important ratio out there is return on equity. So return on equity, when we're looking at the hierarchy of ratios, is at the very top. So if you want to understand whether a company is profitable or not, overall, you look at return on equity. So generally speaking, any form of profitability ratios will have some form of a amount of return divided by amount invested. When we're looking at return on equity, all we're looking at in this particular case is net income divided by average equity. So essentially a profit divided by the average equity that we hold. And the reason why we're using average equity is because, again, the net income is something that we accumulate throughout the year. Equity is a snapshot in time at the end. So by using average equity, we essentially get the midpoint of the year. So we take this year's equity plus last year's equity divided by 2 to get the average equity. So again, return on equity is the most important ratio out there in the sense that this is the one that you need to be able to explain. And the reason why it's so important is because there is a way to try to use it to go further in depth in terms of, I guess, company profitability. So did you guys cover DuPont analysis in your intro to accounting or no? I see. That's fine. DuPont analysis, do you know the DuPont Corporation? No. Really old, like 100, probably even more than 100 years old. It's a company basically came up with something that's called DuPont analysis. And DuPont analysis is the idea that you can try to explain return on equity by decomposing it into its components. So if you're thinking about, I guess, return on equity being at the top of the pyramid, the next level of the pyramid is your return on assets and your leverage. Because generally speaking, when we're looking at DuPont analysis, the first step is that you say that return on equity is a function of a company's return on assets multiplied by its leverage. So the return on assets is basically how much profit you make for each dollar that you hold in assets. And then your leverage is how much do you hold in assets in relation to your equity. So just from this, and again, from this relationship in the sense that return on assets multiplied by leverage equals return on equity, you know that in order to increase profitability of a firm, so in order to increase return on equity, you can either increase return on assets or you can increase leverage. Which one is harder to do? From a company's perspective, which one is easier? Leverage or return on assets to increase?
Leverage.
Why?
It's easy to get debt. It's pretty difficult to increase your return on assets.
Yeah, so generally speaking, if we're looking at most companies out there, the easiest way to boost the return on equity is just borrow money. Borrow money to finance kind of growth and so on. Because generally speaking, if we're looking at return on assets, that's more about the company's operations. And as always, it's much harder to try to improve your own performance rather than to just borrow money to basically increase your leverage. So when we're looking at two different companies with the same return on equity, we can't just look at return on equity. We need to know, how did that return on equity come about? Is it because the company is doing really well at using their assets to generate profits, or is it just because they have a high amount of leverage? But generally speaking, technically, again, let's take the flip side. So the obvious thing is, generally speaking, that high leverage is bad. Why might low leverage be bad? Yes, yeah.
Could maybe show that they're not investing properly or looking to expand.
Yeah, so basically it kind of shows perhaps they're losing opportunities. So if it's cheap to borrow like it is these days, the interest rates are super low, and you have investment opportunities, like you could open up new stores, and you know that the kind of projected return for those stores far exceeds the cost of the debt, it's kind of stupid not to. So generally speaking, high leverage in most cases is something that we consider bad, but in other cases, low leverage could mean the exact same thing. So you generally think that there is some form of an optimal level of leverage. Because again, when times are good, high leverage is not necessarily that bad. Because generally speaking, in boom cycles, interest rates will be kind of lowish, so the repayments are low. It's only when the economy kind of goes downhill that high leverage becomes a problem. So you basically need to keep in mind your future ability to pay it off. So again, when we're looking at decomposing, I guess, return on equity into return on assets and leverage, all we're essentially doing is trying to understand whether the return on equity was determined through the company's strategy or with the financial strategy. So is it its business operations that are driving the high return on equity, or is it their financial strategy where they're essentially borrowing money from banks and so on? So again, when we're looking at any form of return on assets, we could look at it from a different perspectives. So return on assets is, generally speaking, your net income divided by your average assets. And I will say again, if you go on Investopedia, if you go to Google Finance, if you go to Bloomberg, you will find that they have slightly different variations for how they calculate each and every one. So most common, I would say, return on assets is net income divided by average assets. Some people like to adjust net income for interest. Other people like to remove taxation. So some people just look at earnings before interest and tax divided by average assets. And the reason for that is because interest expense, that's more of a reflection of your financial strategy. It's not about your operations. Tax, it's more of something that is kind of subject on you from the kind of jurisdiction that you're in. Again, it's not part of your operations. So some people like to actually break apart return on assets to separate out the interest burden and the tax burden. So again, when we're looking at return on assets, technically speaking, again, if you think about return on equity is the highest level of the pyramid, then we decompose it into leverage and return on assets. Third level, you can then decompose return on assets itself. So generally speaking, when we're looking at a company's ability to generate profit from its asset base, it can be attributed to one of two things or a combination, and that is from its profit margin or its turnover. So profit margin is how much do you make in profit for each dollar in revenue that you essentially make, and then the turnover is how much revenue do you make for each dollar in average assets that you hold. So the idea here is that you're looking at two different parts of the company's operations. So one is just about kind of cost efficiency almost, in the sense that you're trying to make sure that you're minimizing costs in order to keep as much as possible at the end. And the other one is to boost turnover. Generally speaking, we say that there is a trade-off between these two. So it's very hard to grow both at the same time. So again, as I made the example, if we're looking at Toyota, Toyota will probably have a slightly lower profit margin than BMW. But Toyota will generally have a higher turnover because they'll generally make higher revenues for the amount of assets that they hold. Similarly, if you think about clothes, if you think about like a company like, let's say Armani or Gucci or whatever the kind of luxury brands, compared to like H&M or some of the like low tier fast fashion brands, a fast fashion brand will have a very high turnover but a low profit margin. A luxury brand will have the exact opposite in the sense that they have a high profit margin but a low turnover. And again, if you're looking at airlines, Jetstar, low profit margin, high turnover. Qantas, higher profit margin, lower turnover. So the idea is that the company's strategy becomes very apparent when you break it apart into these two components. So one is generally a cost leader strategy. The other one is usually some form of a differentiation strategy. So if you have a differentiation strategy, you're more likely to have some kind of a luxury brand. If you're a cost strategy, well, again, your Jetstar, your Tiger, you don't care about your brand that much. All you want to is essentially compete on price. So again, because there's a trade-off between these two, there's going to be problems in increasing both at the same time. So again, say for example, Jetstar started to increase their prices on their seats. Well, generally what would happen is that their revenue would decrease. Why? Because the higher the prices, the lower likelihood it is that a consumer would choose them over their competitor. So it's really hard to grow these at the same time. The only way you usually grow these at the same time is if you might have like a patent or something that protects your position in the market. But again, very difficult to do over a long period of time. So again, when we're looking at return on equity, generally speaking, again, if you look at it from a 3-tier level in the pyramid, so return on equity, then we're looking at return on assets and leverage, and then we decompose the return on assets into profit margin and the asset turnover. We could effectively say that, technically speaking, return on equity is comprised of 3 things, and that is your profit margin multiplied by your turnover multiplied by your leverage. So again, the DuPont analysis, it's really, really basic, because it's really only 3 ratios in there, but it provides a really good insight on a very quick way to do it, to try to understand why a company has a certain amount of returns on their equity.
Excuse me, Tim.
Yeah.
Why do we use average assets instead of total assets?
So the idea behind the average assets is really that you're trying to match your net income, or let's say like your revenue with your assets. Your revenue, let's say your 2017 revenue, that reflects revenue that you would have accumulated throughout the year. Whereas if you look at average, or say total assets at the end of 2017, that's a snapshot at the end of the year. So if you started with 0 in the beginning and then you accumulated 100 million of assets at the end, your end figure is 100, your beginning figure is 0, so the average is 50. The idea is how much on average did you hold throughout the year. And again, if you have a stable company, it's not going to make a huge difference whether you use total basically assets or average assets. But if there's fluctuations, you generally should do this.
Is that like a safeguard against, like, if, well, it's probably not really assets, but like if someone was like increasing inventory for like the financial report to try and...
Yeah, so like in terms of like red flag, like if somebody were to manipulate some accounts, there would be a slightly lower effect when you use average assets, because you would basically incorporate some issues, some kind of numbers from the beginning of the period as well. But on the flip side, if somebody had manipulated the prior year's amounts, but not this year's, it's kind of has the reverse effect. But again, generally speaking, what we're doing this here is really because we're trying to match up these numbers. Because again, net income is a flow figure that kind of flows on throughout the year. It's an accumulation over time. Whereas average assets is again total assets at the end of the year. It's a snapshot in time. So in order to kind of match these up, we use average assets to kind of assume that we're kind of in the middle of the year somewhere. So again, when we decompose return on equity to these 3 parts, and again, when I look at your reports and when you do this for your company, probably the most important part is the DuPont analysis, because DuPont analysis effectively provides you with, do you guys want a break perhaps? Or is it like, yeah? Yes? Okay, so as last semester, whoever says yes or no first wins. So we have a break, let's say 10 minutes, and we come back in 10 minutes. All right, so let's basically continue and finish off the lecture. So again, just to recap, basically the whole point of return on equity and decomposition is to be able to understand which part is contributing to the performance of the firm and how, or the overall profitability of the firm and how. So generally speaking, again, you could say return on equity is made up of profit margin, turnover, and leverage. So again, was the source of competitive advantage or the superior return on equity derived from selling at a high margin? So about their margin. So perhaps they were selling something at a very high price that didn't cost them that much money to actually make, in which case they have a high profit margin. Or is it from generating higher sales from a lower investment in assets? So essentially you have a high turnover or efficiency. Or was it derived from investing in a lower amount of equity by using more debt in its capital structure? So again, you can look at leverage, profit margin, or asset efficiency as one of the 3 drivers. So even if you think about it from a management perspective, A manager knows that if I want to boost my return on equity, I can either borrow money, try to improve my efficiency, or increase my profit margins. Some of them are harder than others. Generally speaking, leverage is the easiest one to actually do. Now, again, like I mentioned with leverage, in a sense that technically high leverage, generally speaking, is bad, but even low leverage could be bad as well, because it could mean that you're basically missing out on investment opportunities. Similarly, when we look at asset turnover and net profit margin, sometimes they can also not necessarily be as obvious. And I'll kind of just explain why in the next few slides. So here we have an example of 3 companies that effectively have different numbers, but if you were to look at the return on equity, it's exactly the same. So it's 20% for all 3 firms. They have different amount of sales, different amount of net income, average assets, and so on, but the return on equity is exactly the same. So if you were to analyze it and they were in the same industry, a really bad analysis would say that company A is just as good as company B and C. They're doing basically equally well. That's a really bad analysis. So the better analysis would then try to decompose return on equity into its components to try to explain why this is occurring. So you could find that the company A is achieving the return on equity by having a much higher profit margin, but much lower leverage than the others. Whereas if you look at company C, again, you see company C has very low profit margins, but has a higher leverage and a higher asset turnover. So again, there's different ways that you can kind of increase either of those 3. Is any of them better technically?
It would be better not to have liabilities, but then,
Wouldn't it just depend on the motives behind it?
Yeah, you basically want to basically ask yourself, why is this happening? So generally speaking, again, this is the first indicator. So you want to understand, is this an accident or is this deliberate? Is this an accident or is this deliberate? Similar to here. Specifically, when we're looking at leverage, just because we see low leverage, we don't necessarily always assume it's good, because it could just mean that they're borrowing too little. So they're losing out on opportunities. We'll come to this, I think, in about 2 weeks' time. But generally speaking, having a net profit margin, historically speaking, is generally considered a good thing. But one thing about the profit margin is that it tends to revert to the mean over time, which means that if you're making a much higher profit margin than your competitor, what generally happens over time is that the worst one increases their margin, the best one decreases their margin. And really that is more of a result from competitive forces. So if you're looking at return on equities and so on, even the ratio as a whole, if you look at historically speaking, over time, companies become very similar. You will have outliers where companies have consistently outperformed the market year after year, but on average, you'll find that they revert back to the industry mean. And again, this competitive forces, because if I see a company is generating high return on equity by selling a particular product that I'm not selling, well, they're making really good money from this product, I'm going to do exactly the same thing. Unless there's like some form of a patent or trademark that kind of prohibits me. But again, the idea is that technically speaking, some of these, specifically net profit margin, reverts to the mean very, very strongly. So if I know that this company A's superior performance is from a high profit margin, I also know that technically speaking, over time, that superior performance will probably decrease. Whereas if you look at turnover and leverage, they don't revert to the mean at such kind of an extreme rate. So again, basically just the idea of understanding that you can't just look at return on equities, you need to basically look at the composition. But again, composition itself does not tell you anything except numbers. You want to understand why is this happening. And again, macro, industry, strategy. So which of those 3 explain it? It could just be an accident as well. But again, you want to understand whether it's a macroeconomic, industry level, or some form of a company level effect here. And again, even if we look at a real life example with like Apple, HP, and Dell, we see vastly different return on equities, but we also see that they're kind of generated in a slightly different way. So for example, if we look at Dell has a huge return on equity compared to Apple and HP, but it doesn't always mean that that's amazing, because basically right now it looks like they're basically have double or triple the performance in terms of their overall profitability. but we see that a majority of this is basically driven by their leverage. And again, doesn't naturally mean that it's always a horrible idea to have this high amount of leverage, but it could mean that they're gonna have problems when the company faces like a recession or something similar. So again, really what we're looking at DuPont analysis is just try to basically provide you with a process approach for analyzing a company. So you're figuring out, okay, so let's look at return on equity, let's look at its components and explain and understand each and every one. Now again, DuPont analysis is kind of something that is very, very standard. You will see that even when it comes to DuPont analysis, some people like to do it slightly differently. So I said that on the previous slide, I said return on equity is primarily made up of profit margin, asset turnover, and leverage, 3 ratios. Some people like to decompose it into 5. So what they are essentially doing is they're decomposing it into the tax burden, interest burden, and instead of the profit margin, they're looking at the EBIT margin. So essentially they separate out the tax and interest effect. And the whole idea behind this is that tax and interest is to a large extent outside of the kind of ability of the company to kind of manage that well. Because generally speaking, if we wanted to understand the profit margin of a business, the EBIT margin will tell you a whole lot more information than the kind of the profit margin as a whole. The reason for that is because the EBIT margin removes the effect of interest and tax. And again, tax is set by country level, so you kind of try to avoid it somehow. You try to structure operations, but it's still something that's going to be there. So if you include tax burden in your profit margin calculations, it's going to basically lose some of its meaning. Similarly, when we're looking at interest burden is more or less a direct result of leverage. So the higher leverage you have, the more of an interest burden you have. So if you effectively want to kind of separate out profit margin and leverage, you really need to remove the interest burden from the profit margin. Again, you're doing this into separating into 3 components. And again, the main difference between the EBIT margin and the profit margin is that we're using earnings before interest and tax instead of net income or net profit at the top. That's really the only difference. And we then take the 2 other parts, which is the interest and the tax, and look at them separately.
Is there one better than the other?
I would probably say that this one is more used in industry. From a trying to teach students perspective, this is much easier because it has 3 components. This one is probably used more heavily. So if you go on Bloomberg, you'll see they do a decomposition when it comes to these 5 factors. But again, if you're comparing, for example, companies that are very similar, it might not necessarily make a huge difference. But again, I prefer technically to use 5-way decomposition. Again, there's other profitability ratios because again, DuPont analysis is basically a way to decompose profitability, but there are other ratios out there. So we've looked at the net profit margin, which is part of the DuPont analysis, but you could also look at things like gross profit margin, which is really about looking at the gross profits in relation to revenue, and you could look at the operating profit margin. So some of you might look and see, think, what is the difference between some of these? Well, again, net profit margin is essentially how much you make in net after your after taxes and everything in relation to your revenue. Gross profit is essentially the gross profit is essentially your revenue minus your cost of sales or cost of goods sold. And then your operating profit is not only your revenue minus your cost of goods sold, but also some administrative, advertising expenses, and anything that essentially is there to support the operations of the business. So generally speaking, the gross profit margin will be the largest, the operating profit margin will be lower, and net profit margin will be the smallest. Because again, you have more expenses at each level. So again, cost of goods sold plus some operating expenses, cost of goods sold plus operating expenses plus interest plus tax and all these other things. So again, profitability ratios, they're really just there for you to understand where the profitability is heading. And again, you're only using it to try to tell a story. Now, activity ratios, which is the next category we're talking about, essentially we're looking at how efficient the company is at managing its operations and assets. And again, asset turnover, which is part of your DuPont analysis, is a form of activity ratio. So that is kind of how all of these interlink. Because just because you're looking at profitability, when you're looking at profitability, you'll generally cover the rest as well. So there is a lot of overlap between these categories. So again, when we're looking at activity ratios, what we want to understand is how good the company is at using its assets to generate some form of revenue or returns. Because you basically want to know whether they're, I guess, efficient at using their assets. So when we're looking at activity ratios, probably the most common ratio that we usually look at, and the one that is part of the DuPont analysis, is the asset turnover. And again, what it could indicate, so when we're looking at asset turnover, we might see that it's decreasing. If it's decreasing, maybe it's because sales are sluggish, in the sense that sales have decreased. Maybe on the other hand, it is because we've made heavy investment in assets, so we essentially increased the amount of assets we hold. And we haven't necessarily generated any revenues from those yet. But just because we see a decrease in asset turnover does not mean it's a bad thing. Because again, we might see a decrease in asset turnover because of huge investments in assets. But these investments in assets essentially might make our company's operations more modern, might increase our production capacity, but in the future. So again, you'll always need to understand, if it's decreasing, why is it decreasing? Is there some form of strategy reason behind it? So just investing in assets, that's kind of explaining it, but then if you can try to explain what that investment in assets will entail in the future, you can try to explain if it's going to be a good thing or a bad thing. So again, what we're looking for is essentially how good you are at using your assets. And again, you can calculate in many different categories. Some people like to look at fixed asset turnover and so on. So again, when we're looking at activity ratios, probably the three most common one is working capital turnover, fixed asset turnover, and total asset turnover. Again, these are different ratios. You'll be like, oh, different ratios, what do they mean? Generally speaking, the most important one is total asset turnover. If you're thinking about, I guess, what do I need to really understand from this group, it's total asset turnover. We have other types of activity ratios as well, things like inventory turnover, which is your cost of sales divided by your average inventory. So essentially, how many times over do you turn over your inventory throughout the year? Generally speaking, the high number means that you turn over your inventory quicker. So if you have a high inventory turnover, it essentially means that you probably have inventory on hand at shorter periods. So essentially, you could try to express it as days of inventory on hand, which means that you should take the number of days in a period, say it's example a year, 365 divided by inventory turnover, and that tells you on average how many days do you hold your inventory until you sell it completely. So let's look at this. So is a high inventory turnover good or bad? Depends. That's great. That's basically the end point of this class, or as it gets this subject, is it all depends. So high inventory turnover, why is it good?
You're doing lots of sales.
Yeah, doing lots of sales. You're selling your inventory quickly. Let's look at the flip side. Why might it be bad?
You might not have enough inventory on hand.
Perfect. Yeah, so generally speaking, the flip side is you might not have enough inventory on hand, which might lead to you losing out on sales. So if a customer wants to buy something, it's not in stock, you're losing out on that sale. So a company that has more of a just-in-time approach will generally have a very high inventory turnover, but it might be at the expense of losing out on some sales. And again, you could look at turnover other things like receivables turnover or your payables turnover and so on. So again, for example, receivables turnover is essentially how much revenue you get from your average amounts of receivables. Whereas your payables turnover is essentially your purchases divided by your average trade payables. And again, for all of these, a high ratio might be good, a low ratio might be good as well. So there's usually two-way approach, and it says that both things could be good or bad. There's no kind of absolute rule for that this should always be high or low. So say, for example, if we're looking at days of sales outstanding, well, let's say if a company collects their credit sales quickly, generally speaking, the obvious answer is that this is a good thing. What's the bad answer here? If they're collecting their sales quickly, what could they indicate? I think we actually just mentioned it earlier. So generally speaking, what it means is that perhaps you're losing out on sales that you could have made. So when you have a very quick time when you collect your credit sales, it indicates that you have a very strict credit policy. That essentially you're able to collect on the money within a few days, within 30 days. What that tells me is that yes, you're really good at collecting money, or it could mean that you just have a very strict credit policy. If you have a too strict of a credit policy, again, you're losing out on sales because there's generally some form of an optimal level, which is kind of hard to sometimes figure out exactly where it is, where you essentially make credit sales basically in order to maximize your revenue. So again, when we're looking at activity ratios, you could look at things like your cash cycle. So essentially it's how long does it take for the firm to go from cash to cash. And that means it's from you spending cash, so let's say you're a manufacturing company, from buying the raw materials with cash to making the, product, to selling the product, to receiving the cash to pay for the materials and labor. Because essentially you want to have a short cash cycle because it has a very close link to liquidity. Because the quicker you can essentially collect the cash that you spent initially, the quicker and the better your liquidity is. And again, the cash conversion cycle is merely your days sales outstanding from the previous slides, plus your days inventory held, minus your number of days payable. And again, what you see is here, this activity ratio, very close link to liquidity because again, all these categories are interlinked. Now again, liquidity ratio, which is the next one, is essentially about the company's ability to meet short-term obligations. When we're looking at short-term obligations, if you've done accounting in the past, and you would have done a few accounting subjects in the past, you would know that the main information point about the company's liquidity is within its current assets and current liabilities. Because those are the ones that are going to be maturing within the next 12 months or within the kind of the operating cycle. So generally speaking, there's three main ratios that people tend to look at. Probably the most two important ones are the ones at the top, and the cash ratio is slightly less important. So all of them are looking at your ability to meet your short-term obligations. And your short-term obligations are always considered to be your current liabilities. Because again, those are the liabilities that you generally will need to pay off within 12 months. So if you don't have enough assets on hand to pay off the liabilities in the next 12 months, it's really, really bad. So you generally want to make sure that all these ratios, specifically the top ones, are above 1. If they're above 1, it means that you have enough assets on hand to pay off your liabilities within the next 12 months. So again, current ratio is just your current assets divided by current liabilities, whereas quick ratio is slightly more conservative. Because quick ratio says, well, technically some of the current assets is not as liquid as some others. So from a quick ratio perspective, you would generally only look at your cash, your short-term investments, and your accounts receivables as your liquid means. What is missing there, for example? Within current assets, what other things could be in there?
Property, plant, and equipment.
Could be, usually that's a long term, but if you think about short term, if I sell bicycles in my store, what do I have on hand? Inventory. So inventory is not in here. That's kind of the main difference for most companies. But again, it's basically just a more conservative approach to figure out the liquidity of a firm. So again, generally speaking, one of those two is the one that gets used the most. Cash ratio is the extreme form. In the sense they're just looking at your cash and your short-term investments that you can sell off quickly and compare it to your current liabilities. Again, it's a very conservative approach because generally speaking, if you're looking at accounts receivable, it's very easy to either collect or at worst case, you sell them to a factoring firm, which essentially might pay you like 90 cents on the dollar. So it's still something liquid, but it might be slightly less liquid than, for example, cash or short-term investments. But again, the whole point of liquidity ratio is just to understand whether this firm is going to be able to meet its short-term obligations. So for most firms, this is not a big part. So liquidity is something that is managed quite well for a stable firm. So for all your project companies, this is not going to be an issue. For a startup, this is the part where you really want to look at. So I don't care about profitability because they don't have profits. I don't care about solvency because, well, it's still a startup. I don't care about activity ratios because, again, they probably don't have maybe even revenues. What I care about is liquidity. So they need to have enough, basically, investments on hand, so basically people providing them with capital to pay their short-term obligations. And then we have finally the solvency ratios. Now, solvency ratios is essentially just about meeting long-term obligations. It's not that difficult of a concept, and most of you would have covered most of these ratios in the past, in the sense that when we're looking at long-term obligations, we might look at debt to total assets, debt to total equity, debt to total capital, or any variation. So essentially you're looking at your liability or some form of a liability in relation to an asset or an equity, because it kind of tells you how high leverage you have. Again, generally speaking, is the obvious answer here is that the lower ratio is better because it's safer. But again, the less obvious answer is some ratios could be too low. It could indicate that they're missing opportunities that it could have taken. Again, you have some other ratios that are, I guess, somewhat related. Things like EBIT, interest coverage, which is basically your interest coverage ratio. And the idea behind the interest coverage ratio is really about how many times over can you meet your interest payment with your profits. So if you're basically losing money within the business, but you still have interest payments, it's a really bad sign. So generally speaking, you want to have a high interest coverage ratio because it indicates you can pay all of your interest payments quite easily. So again, when we're looking at solvency, it's pretty standard. It's pretty, I guess, normal stuff that you probably would have encountered in other subjects. Again, when you're looking at some of these numerators and denominators, you see the word debt instead of liabilities. Generally speaking, when we're looking at debt, we're looking at interest-bearing liabilities. That's kind of the big difference. Usually speaking, there's a huge overlap between total liabilities and debt, but there might be some differences. But again, what you kind of need to consider is when you're looking at any of these ratios is, again, they're just the starting point. And again, as I mentioned, you're basically using it to try to tell a story. If you can't basically answer why something has happened, you're not necessarily providing, I guess, the most effective answers. You always want to be able to answer why something is happening. If I see that let's say the debt to asset ratio is really high, I want to answer why is it really high. So when I look at why is it high, I'm going to look at total debt and total assets. Is one of them really large in comparison to the competitors? Then I'm going to answer why is it happening from the strategy perspective. So is it a macroeconomic effect? Is it a industry effect? Or is it a strategy on a company level effect? If it's a strategy effect, again, is it a reasonable strategy? Why is it differing from their competitors? Because generally speaking, when you have companies that are very similar, they will tend to adopt similar strategies because you generally follow the leader, which means that over time, companies become very similar to each other. So again, when we're looking at any of these ratios, the idea is to tell a story, and the story will be the story that you're then going to be using for forecasting. So all that we're doing today is essentially, and I guess Thursday, is going back in the past, telling a story in order so we can kind of continue into the next chapter, which is forecasting. Do you have any questions? Easy? Again, you can stick around and start working on a project, but I'm seeing that a lot of groups don't have a lot of members. That's cool. You could come back on Thursday because I know some people just like to come here on Thursdays because that's when the groups are working. But again, thank you for coming. If you want to run out, if you want to stay and work, I'll come around and help you guys individually.